This TwinPetes Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the TwinPetes Investing podcast. My name is Peter Higgins and you can find me on Twitter at Conquest3. And I'm here with my favorite and best co-host, Peter at Wheelie Dealer on Twitter. Peter, how are you, mate?
Yeah, all right. You know, usual ailments, but I'm all right. I've been worse. Cool.
Pete, we're gonna have to just dive straight in here, mate, because It's been an absolute roller coaster for the past week and a bit, culminating on Monday of this week. We're now recording this on the 26th of January, Wednesday, but we're going to take you, ladies and gents, back to Monday, where the markets just went all over the shop, and the FTSE got absolutely smashed by 2.6%. The Dow Jones, though, it recorded its first ever 1,000 point plus intraday U-turn to result in a gain, right? So the markets were just absolutely getting spanked, and in the latter part of their trading day on Monday, it reversed. And obviously we'd already closed that day. The index, the Dow Jones index, at its an intraday low of 33,150, and it marked a 1,214 point turnaround to finish in positive territory. First time that it's done that ever. S&P similarly finished up after being down significantly, and NASDAQ did the same. So an absolutely staggering move. Some of the stocks really on the UK index got absolutely spanked. So a couple of examples, Pete, on Monday.
Yeah, we
had PEARSON out -9%. Barrett Developments, builder, down 8.9%. Tech related British Mortgage Trust down 8.5%.
The builders,
those are the losers. Yeah.
The builders had the construction, the worries around the levy and the tax levy on the cladding and stuff as well, didn't they? So that didn't help them at all.
Yeah, and PSON came out with some news as well.
Yeah,
and we've since found out that Nick Train has had enough and he's halved his position in PSON, so that's not going to go down well either. So that's probably going to be sitting at lows for a little while.
I mean, Nick Train, what is he? The Lindsell Train Fund or something?
Lindsell Train, yeah.
And he's very much long-term investor, and he is stuck with PEARSON forever. You know what I mean? So for him to come out and not be so sticking with it, it sort of does make you wonder, doesn't it?
It does. We had a couple of winners though, Pete, and I think one of them was yours. Do you still hold Vodafone?
Oh yeah, that was weird, wasn't it?
Yeah, on Monday that was up 4%, Pete, because there's some talk that they might be looking to align themselves with some other people, so that helped them on Monday.
Yeah, it's funny because
did you see that?
Yeah, well, Vodafone VOD is one that I'd been mentioning it for a while because it had started that sort of steady move up before that news came out, and it just kept moving up, and I thought there's definitely something happening here. And it was particularly in a kind of soggy market, when a stock is sort of continually making these little gains, you think something's going on, so it wasn't a big shock when I sort of heard the news. And was it one of the, apparently some of the private equity companies might be interested and stuff like that, so there's a bit of a story there. I looking at the chart, I think it could go up to like 140 or something. So, in the shortish term. So, I mean, getting over 140 is brilliant.
Yeah, there's talk that there's rumors that US telecom firms or private equity sharks could be eyeing up the group following the 9 billion swoop on Telecom Italia. by New York group KKR last year. So there's lots of talk about that going on. So that's why that popped. And then there was activists in talk regarding Unilever, because when we recorded the last podcast, during the time since, there was talk about Unilever trying to buy GSK, GLAXO Wellcome. And that lasted about a week. They'd already bid 3 times, got rejected. 50 billion pounds was being asked, and they went, "Oh, we can't afford that." And then sentiment just went completely against Unilever. The city investors, etc., said, "No, don't be going buying GLAXO Wellcome, because that's a bad move. It's don't overpay for it and all the rest of it." And then they decided not to do that. And whilst they were thinking about it, their share price dropped 10% the Friday before the Monday crash. And then they bounced 7% once they'd said that they wouldn't proceed, and that activists were getting involved or looking at the stock as well. So that was interesting.
From memory, Unilever's been a little bit out of favor for a while. I think there was all the talk that, with economies being a bit wobbly and with inflation, so, the cost of their inputs was going up, and with the economies being a bit weaker, maybe punters wouldn't be so happy to pay for brands, and they would go for, the sort of supermarket owned labels and stuff. And looking at the chart, it's interesting. You look at a 3-year chart, well, there is one. 3-year chart. There it is. 3-year chart. It's just been going down. So, it was already in trouble, and then that just added to its woes, didn't it?
Yeah, there's been a lot of inflationary difficulties, supply chain difficulties, costs, capex costs going up, etc. So not many things have been in its favor, really, and it's a global entity. So just shipping some of their products around the world has been costing them an absolute fortune, and that's something we've talked about regarding numerous stocks, regarding logistic costs and inflationary costs and inflationary pressures, and even just the cost of running a behemoth company with tens of thousands of employees. That's a cost that's been creeping up over the last 3 years as well. So that's been a negative for them. And also the competition against own brands, people producing their own brands now, companies, so that's a difficulty for them. So in the FTSE 250 on Monday, that was down 3.6%. That's usually the heartbeat of the FTSE All Share. That was down 3.6%. The big winner on that one was Playtech, which is still going through lots of rumor talk and all the rest of it, speculation about the takeover coming or not coming, at what price it might arrive, and so on and so forth. Significant losers were Reach, which we've spoken about before, the media company, down 11%. TrustPilot was down 9%. Not sure why. I didn't really see much news on that one, but that obviously is a tech-related stock. That was down 9%. And the AIM All Share on Monday fell 4.77%, Pete. Absolutely got spanked. But this is the bit that's sorry, go on.
The AIM index has been an absolute pig for ages. I mean, from memory, it literally goes back to maybe halfway through 2021. It sort of peaked and started coming off, and it's just been down. I think it's affected a lot by the bigger players in the AIM index, like ASOS and Boohoo. I think they've taken it down with them quite a lot, but it has been quite a shockingly bad index, for a while.
It sure has. So the thing that stuck out for me on the AIM All Share on Monday when I was looking at it was that the biggest winner, Pete, and this is the irony of ironies, right, is a company called GYG, Pete. Yeah. And I think we've spoken about this.
It's the yacht one.
Yeah. GYG PLC. Yeah. And what do? They are the market leading super yacht painting, supply, maintenance company, offering services globally through operations in the Med, Northern Europe, and United States. If the world is going to blank in a fiery basket, what do we investors need to do? We need to consider investing in a company that maintains the ultra rich yachts. That's what we need to be doing, apparently.
Super yachts.
The super yachts, mate. That's what we need to invest in, people. So forget about SMT, forget about Microsoft. Invest in the company that repairs and maintains super yachts. That's what we need to be doing. We're all doing it wrong, right? The losers on AIM, and this company's been getting absolutely spanked, is the Wildcat driller ADVP. I'm not sure you've been watching this one.
I've heard about it, yeah.
Yeah, it was until recently. Advanced Energy, a Wildcat driller, and the share price was something around 6 pence, or thereabouts. And it halved one day. It went down 90% one day. It went down again 62% on Monday. It's again down another 11% today when the markets have been going back up. And the share price has essentially gone from 6 pence at one of its peaks, recent peaks, and I say recent peak because it was about 17th of January, which is like a week and a bit ago.
Yeah,
a week ago on Monday. A week ago on Monday, it was nearly 6 pence, and now it's 0.4 pence. Yeah, so a quarter of a penny, folks, from 6 full pence. Right.
The loss on there. If you paid 6p, you have been absolutely caned in a few days. Horrendous. This is
the difficulty with wildcat drilling companies, and which is the reason why I tend to avoid them. They're very, very binary, and a lot of the money can be made and has been made by other people that have got in the past 6 months prior to the actual outcome of this wild drill. Yeah. So you make your investment, right, in, where are we now? July. We're in January. So July, August time, you make your investment then, right, with the views that this wildcat thing is going to be coming up. And then when you get towards the month before the drill results, you take off 30, 40, 50, 60% of that investment, or sorry, punt, gamble, if you want to call it that.
Yeah.
If it then goes up and it's a fantastic result, yeah, the share price goes up 100%, 50%, 80%.
Oh, you're still in it.
You make some more money.
Yeah.
But if it's a fail, like this one is, you lose 99% of your money.
The shocker.
So that's what people have got to think about, and they simply didn't. A lot of people just held on. It's just like, lots of other people say, oh, it's a certainty, it's a certainty, it's certainty. There's no such thing as a certainty in a wildcat drill. My sympathies for everybody and anybody that's got or had that stock or lost money on that stock. But the learning here, and I've been here myself with biotech type companies that have absolutely created on the day of the results, is everyone's been saying FDA is going to approve it. Oh yeah, it's a certainty, it's certainty. And I've woke up in the morning, the share price has been down 80%. I've been there. I won't do that again. You know,
it's the classic overconfidence thing. People think for some weird reason that if they bought into that company, they knew more than BP, Shell, all these great oil businesses who they weren't interested in it. Why is it that members of the public, just retail people living in their little boxes wherever, are able to buy this thing? I mean, the alarm bells should be ringing, you know. It's like people just seem to think they're buying surefire winners, and there's no such thing, you know. There is no source. Even if you buy Unilever, it's not a surefire winner. There is no such thing as a surefire winner on the stock market. And, you know, you've got it comes back to what Jason said, you know, at Stealth Surfer, he said when we did that podcast with him, when he said, I hate each of my stocks equally. I just thought that was brilliant. And I think that's how you got to look at it. Whenever you buy a stock, you've got to think, right, you know, I've just put 2,000 quid, 5,000 quid, 20,000, whatever you put into it. Yeah. I've just put this money into this stock. I am now at risk of losing that money. But instead, people put 20 grand into this stock, all the money they've ever saved in their lives, and they think it's going to be 100 grand next week. And it's just absolute fucking nonsense. And it's overconfidence. It's absolutely overconfidence.
It is, Pete, and I feel for the people that have lost the money on ADV. I've lost significant amount of money in the past on binary plays, on FDA outcomes, and the odd oil outcome as well. And I won't do that anymore now. I tend to take a large chunk off the table. I've just done that actually. Yeah, what day was it? Yesterday. I did it with Angle AGL. I took some off the table there, and that's going to have FDA outcomes and so on and so forth in the next couple of months. Because on Monday and Tuesday, I just didn't want to add any more money to the market. You know, I thought, you know what, that's holding up reasonably well. It's got FDA coming out. I've got an excuse here to take some money off the table. I took some off. I've invested in a stock that I've always, well, I've wanted to buy for some time, and I was in the market on Monday, you know, having trimmed a little bit of angle off. Yeah, I was in the market when everyone else was running out of the doors. I was buying, because that's what I do. When the markets are really, really poor or really, really bad, I'm not hiding behind a sofa. I'm not, you know, closing my laptop down and going for long walks and crying because the markets have given me a good hiding. I'm looking for what the bargains are. I'm looking for, oh, that's a stock there that I wanted before. Of course, it could go lower. And the likelihood is that it probably will go lower in the next few days or next couple of months. But I've started to invest the amount that I wanted to invest. So if I'm going to invest 10 grand or 50 grand, 100 grand, I'm going to go in 3 or 4 or 5 times.
Yeah, exactly.
And spread that weighting between that into that stock on 3 or 4 or 5 different occasions until I've got the percentage of that stock that I want.
Yeah.
You know, on Monday, Pete, one of the stocks I've held for a long time, I spoke about it, I won't going to go into detail about it again. 4D, DDDD. I've been holding that forever. I've said how bad it's been for me, right?
Yeah.
And I thought, all right, okay, I'm just going to wait until all this stuff happens with the pipeline. Monday, it got spanked again, right? Minus 16%. So I put it out on Twitter. There you go, down 16%. Tech Capital, it's been on a fantastic run for me, up threefold in less than a year and a bit, right? Wow. Down 14%. Yeah, my lithium play, all Atlantic Lithium, down 14%. Yeah.
Yeah, big hit.
ITM, which I've had forever, that was up 27-fold for me at one stage, down 11%.
Yeah.
Yeah. Insync AI, down 10%. All of it's on Twitter, Pete. Yeah. I'm not hiding. I'm just trying to show the transparency here and to show the importance of sharing the good, the bad, and the indifferent. Because the whole point of this market and this investing stuff is that it's not easy. So when it's good, share the information with people. Yeah. When it's bad, share the information with people. Don't just come out and say, "Oh, I've been hiding all day, and is it okay to come out now because I'm not sure what the market's like?" Yes, it's funny, and trying to jolly each other on, but share the good and the bad. Share your positions that are down 10%, 5%, 15% with people, share, as you would do when they're up 10 or 15% as well.
Oh yeah, well, it's easy to shout when your stocks are doing well, isn't it? And I'm sure I'm as guilty as the next man on that one, because it's, I mean, you know, on a day like Monday, you know, I pay a lot of attention in the morning and stuff. I see what's going on, but basically, you know, I've lost interest. Then there is no point me looking at it. I'll come back to it later in the day. I had no intention to buy anything. I had no intention to sell anything. All I was focused on was, do I need to hedge or not? That's the only question I have to consider. I wasn't hedged, which was very uncomfortable, and I don't like being in that situation. But I knew I had plenty of cash in my spread bet account. I knew I could take quite a hit. I knew I had no reason to worry. I didn't see that this was like a massive sell-off that was going to be like we had back in March 2020 or anything. And I just thought, this is just, you know, it's just early days on a year when we got lots going on with Ukraine, lots going on in the economy. We've got a prime minister who's doing his desperate utmost to be hounded out of office. You know, there's so much going on, and you just think, well, you know, coming out of the pandemic and stuff, and you know, whatever, you just think there's so much going on. I just didn't think this was there weren't any clear reason for the market to be selling off. You look back at March 2020, right? The reason you get big sell-offs is when everyone's thinking the same. There is no buyers because everybody is a seller. And then you get these massive collapses because we're all thinking the same. On Monday, I don't think anyone could coherently say what the reason was for the market falling. You know, I mentioned it on Twitter. I got about 4 or 5 different versions of why the market was falling on that day. It wasn't all people thinking the same way. And there was a lot of people like you who were actually buying. So, you know, it just didn't feel to me like that kind of total mega sell-off. So I didn't get the sort of urge to be hedging particularly and going crazy on it. If certain support levels had gone, I would have hedged, because then I would have got worried thinking there's something going on here. But as it was, I just thought, let it be. It'll go down, it will go up. Just don't worry about it.
Yeah, I mean, the thing for me, Pete, was there's a sheer scale of panic. It was a sheer scale of panic, mate. And the FTSE 100, I was reading from a Sky article that the FTSE had 53 billion wiped off in one day, you know, and they were quoting the Russia-Ukraine sort of cocktail that was going on. You know, there was concerns about the Fed potentially, you know,
the Ukraine didn't make sense.
Today, raising rates. You know, China potentially sending, you know, whatever to Taiwan, all the tensions being raised. There's all these multiple fears, and the cocktail of all those was what people were saying triggered it. But then on Monday afternoon in America, whoosh, you've got a 1,000-point return back to where the markets have started from. Yeah, you know, and they're up again today. So I think it's one of those, Pete. I think people get to the point where they don't need much of a nudge to panic, because they don't trust the markets, and the markets have been on a very, very good run up until, you know, middle of December, and we started out in the new year hitting highs, Pete, only a week and a bit ago, hitting highs for the FTSE. And the conversation we're having 2 weeks ago with people talking about there being, you know, potential visit in 8,000. Today we've had a bit of a bounce again. We're sitting at FTSE 100's at 7,469, up 1.33%. FTSE 250 up 1% at 21,873. FTSE All Share at 4,192, up 1.29%. FTSE AIM All Share is up 1.21% at 1,097. And that's the volatility for you, mate. We're back to where the marks are going up almost on a daily basis, intraday plus and minus 2%. And that volatility is going to shake a lot of people out, because in amongst those sort of moves, there are some stocks, and if they dare warn, you know, come up with a profit warning, they are going to get spanked, mate. You know, Delarue got spanked on Monday. Did you see that? Oh
yeah, I mean, the market is totally unforgiving at the moment, isn't it? It's you know, the slightest indiscretion and you're caned. You know, there is just no mercy at all from the market at the moment. It's definitely in that mood. It's interesting that you look at like the FTSE 100, it's almost back. You know, we're what less than well, we're like 140 points from that high again at once. 130 points from that 4.6 recent high, and I think a lot of that is because RDSB, you know, Shell, BP had really good days today. I can only assume, I mean, we're recording this on Wednesday, 26th of Jan. I can only assume that the oil had a flipping good day today, because I've got SERICA Energy, SQZ, that was up massive, like 8% or something. It was a huge gain today. So I, you know, it's clear that oil is definitely 10% up SERICA today, because that's rather nice, I must say. Yeah, so oil obviously played a big part today, and that's helping the FTSE 100. It's interesting.
Oil prices are up. You had Shell, Pete. This is what I'm saying about the movements in the markets, and you've just hit it right on the nail there. What's carrying the markets? You had Royal Dutch Shell up 5%, Pete.
It's massive.
It's up 43% plus.
Yeah.
Right, in the past 12 months. This is a stock that's market cap is a 64 billion pound market cap. That this time last year, right? This time in January last year, nobody wanted to buy the shares.
I didn't want to hold it.
You couldn't give them away at 40. You couldn't give them away at 14 quid, Pete.
Mate, I hold them, and I didn't want to. And
you didn't want to hold them, yeah. They went because they'd gone to sub £10 in 2020, Pete, when no one wanted them.
I know.
They were sitting there at 14-ish, or sorry, 12-ish this time last year. Yeah, nobody wanted it, mate. Nobody wanted it, and now it's rocking and rolling at 19 quid. People buying it.
Well, now I hold them, and I've held them for years and years, and I even inherited a load from my mum when she went, and you know, I really wanted to get rid of it, because I'm like, well, I don't really think oil stocks have much future, you know, with all the green stuff and whatever. And yet I look at that and I just think, I'm so glad I didn't sell them. It's been probably my best performer this year, you know. It's been stunning.
It's been absolutely stunning, mate. And you know what? With the tensions we've got with China, Russia, Ukraine, Taiwan, and so on and so forth, and inflation as well, it's going to be one of them stocks that the pensions and the funds and all the rest of it, the people that are seeking safety, where they're going to go?
Yeah, and it's paying flipping good dividends and doing share buybacks, and you know, I mean, yeah, I'm happy I stuck with it. One of the things that was interesting.
I mean, just as a comparison here, Pete, right? One of the most talked about shares, and we talk about this share a lot on Twitter, right? And we talk about it a few times here on this podcast. And I forgot to mention the chap who made the donation to the Menphys charity. So I'm going to give him another shout out. DM Keen gave us £3,750 for the TwinPetes challenge last year. So thank you so much for that, sir.
Thanks, mate. Brilliant.
On Monday,
that is awesome.
Yeah, the company that he'd saved the money on, about 260k, right? It hit a 52-week low, Pete, of £78.30. Probably one of the most followed and held stock in the Twitter sphere, right? Regarding UK investors, right? It hit a 52-week low, and I estimate that DM Keen, right, probably would have saved himself from the point that he sold it near and around the high of 123. Yeah, when it hit £78.30, he probably would have saved himself £760,000 plus from selling out of that stock.
Incredible, son.
Yeah,
it's interesting. It seems to be parked around £80 now, and sort of looks like it's trying to find some support. So, for the sake of holders, I hope it does.
I sincerely hope it does, mate, because otherwise there's not a lot of room underneath that. Someone was asking me, and it reminds me, Pete, to ask you to find that email that was sent to you as well, if you've got it in front of you, regarding somebody commenting about the stuff that we talked about and what happened to them. But it reminds me, Pete, of the fact that the difficulty is with this stock is that when it's not going so well, people bring out rumors and say, you know, or potential to say that, oh, Disney could come and buy it and all the rest of it. One of the things I would say, and I've had this conversation with a few people in private, and I'm going to share it with you guys now, is that it's highly unlikely that Disney will ever buy Games Workshop. And the simple reason is Disney is a family orientated business. They're not interested in products that talk about violence and killing. And that's predominantly the games that Games Workshop are involved in. So that's the reason why Disney isn't ever going to buy them. They'll buy other products and other entities, but they're highly unlikely to buy Games Workshop.
Just looking on SharePad.
Have you got that email from before, Pete?
I'll dig out in a second. On Games Workshop, just looking on SharePad, it's on a forecast PE of 20.8, 2-year forecast PE of 20. That's interesting because that tells us that the forecast don't expect the actual forecast to change much from from a year out to 2 years out, which surprises me really. Yeah, maybe the growth will be better than that, who knows. But it's got a forecast dividend of 3% rising to 3.1 and a bit of cash. So I mean, it's one of those where the value case, it still looks, on those numbers, it doesn't look an amazingly cheap stock. Then again, it doesn't really look massively expensive like it once did. So, you know, it's a tough call, isn't it? Mate, if I dig out that email, I'm worried that I'll crash the connection, so it may not be wise.
Right, okay. Let me find it then.
This is a quick hello to you, our valued TwinPetes Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe and you'll always be the first to get the new episodes. Thank you for your continued support.
If you've got it,
right, let me find it. Okay. So so this was sent to you, yeah?
Yeah.
From Jim. And it says, hi Peter. Got to give you and Conkers a massive thank you. If you remember in August, you gave the heads up on the markets before any drop. I took note and started switching to safer stocks, but went 20% cash. Great call on your part. Then on one of your podcasts, late November or early December, not sure exactly, he said he was raising cash. He said he was not happy with the markets. That stops me going back in for the limited December rally. Then early this year, Conker said he was still wary, which made me look more at dropping more more stocks like Fundsmith, Conbrio, anything that had gained loads came under the cosh. I am now at 65% cash, down 1.25%, but would have been down about 7 to 10%, but for you too. So it's not just about what you could have gained, it's what you could have lost is my priority. And you two have helped me in spades. Now my problem is when to get back in. Laugh out loud. Let me know about your fundraise. I owe you both, and I myself have had spinal ops after an accident, lost my career, etc. And my brother, who was a policeman, had a head-on collision whilst in blues and twos with a car traveling the wrong way on a dual carriageway, has many spinal ops. Thankfully, we are now nothing like we both were. Careers gone, nevertheless. So only too well knowing how important health is. Please thank Conkers from me, and thank you once again. Cheers, Jim.
I mean, it was a brilliant email. Thanks, Jim. I mean, I got to give credit to you, Pete, because you were the one who called more the sort of be cautious kind of side of things. I think I was probably a little bit more gung-ho, as I tend to be. But I think that's my default position, is be gung-ho, unless I have to suddenly change tack on a sixpence sort of thing, which I can do because I'll just slam hedges on. But yeah, no, that was brilliant from Jim. On the charity stuff, on the last podcast, TPI 66, I talked about the backup charity for spinal injury and all that stuff. I've been in touch with them. They're really keen to work with us. That's the Backup Trust. Really keen to work with us. So they will be our charity of the year, the TwinPetes Challenge for 2022. We're just getting the Just Giving webpage set up. I would expect for the next podcast, TBI 68, that should be ready in time, I think.
Cool.
So
that's making really good news.
Making progress. I was going to say on the indexes, while we're just thinking of it, one of the things that's really stood out was that all of the major indexes, so I'm talking all the American ones, the Dow, the S&P, the NASDAQ, the CAC, the DAX, pretty much everything, right? The FTSE 250, the AIM, everything. They've all done 13/21 day EMA bear crosses, every single one had, yeah? And the NASDAQ did that ages ago and, whatever. But the interesting thing is the only one that hasn't is the FTSE 100. It nearly did a bear cross. It got towards it last Friday or Monday, and it's now ducked it, which is a really bullish thing. To just divert a bear cross and to turn bullish is a really positive signal. So it's interesting that that's the index that's bucked the trend of all the others.
Okay, so you're seeing that as a positive for the markets going ahead then?
But the FTSE 100, I don't know about the others.
FTSE 100, because because as you said, we're only 100 odd points away from where we're at and high.
Yeah.
A couple of weeks back, given what happened on Monday, no one would have foreseen that. I would have thought we were heading back towards nearer to 7,000, mate. So if that's a positive, then that's something to hang your hat on for a little while, definitely.
It was quite amazing because on Monday night I looked at the charts as I always do, and that was the only one that wasn't bearish, because we hadn't had a bear cross on the 13/21 EMA and exponential moving average, and it was just lining up a bear cross. So I thought, this one could do a bear cross, and then we're really in trouble because they'll all have bear crosses. And then, as we say, yesterday and today, it's managed to put in positive gains, and it now is widening out those EMA lines. So that's really a bullish signal. It can still, it could turn down tomorrow or whatever, but I suspect we're back in the upswing on the FTSE 100. I think we probably are on all of them. What stood out about Monday was that reversal in the US. When you get a reversal like that, when the market is down, what was it down, like 5% or something on the NASDAQ? It was massive. It was a massive down.
It was down a good 4%, mate.
Yeah.
Intraday, if not more.
And then to reverse and be, positive or just down a little bit, put in a hammer candle in effect, which I highlighted on Twitter that night. I said, look, these have done hammers. And the other thing that that helped me a lot was looking at the RSIs. So I think it's the daily RSI, the relative strength index. You looked at the relative strength index on all of those, like the NASDAQ was saying, RSI, the NASDAQ, I think from memory, had an RSI 26. So 30 is low, 26 is really low. So it was telling us that very, very soon it was going to rally. And then we got that bounce, and that just confirmed what the RSI was telling us.
Yeah, and I hope you're right, Pete, because some of the stocks that got spanked on Monday, they haven't quite recovered as quickly as they went down. And this is always often the case, isn't it? You know, the ones that get absolutely spanked when the markets are on a downturn, you know, go down 5, 10, 15, 16%, as we've spoken about. They don't tend to bounce back as quickly when the markets go back up, do they? Because people are weary of them, aren't they?
That's Sod's law as well, isn't it? Interesting on the NASDAQ, right? You look at the candlestick for Monday, we had that down and reversal on Monday. Then yesterday we had a doji candle, which is just like a little tiny candle, but it was inside the range of the Monday candle, yeah? So you need a third candle to complete the pattern. Well, today we've got that third candle, and that third candle is up. So that is telling us, it's called a 3 inside up pattern, which is telling us it's probably going to rise. So it's, yeah, I mean, to be honest, all the indexes are looking to me like they're trying to turn up again.
Cool. I mean, the thing for me, Pete, and we tend to follow, if the US markets has a sneeze, we get a cough or you know, really bad flu, don't we?
We get COVID.
Don't say that word. You know what I mean? But last night, and hopefully this will carry on pushing the US stocks a little bit higher and help us to get back to some sort of, you know, normality, in a sense of the UK markets having a bit of a good few more days other than just today. Microsoft, Pete, you know, the behemoth that everyone says elephants can't run, or elephants can't jump. It just came out with the results last night, and again, you know, it released its 3 months to December 21, the second quarter, its financial year to June 2022, and which were again ahead of expectations. This is a massive behemoth company, Pete, and during the course, the revenues grew at 20% constant rate, you know, to 51.7 billion, slightly ahead of forecast, driven by another strong quarter of cloud business. Commercial bookings grew by 37%, by an increase in the number of larger and long-term Azure cloud contracts. You know, this is a company that has offerings that include Windows, everyone uses, Office, most people use, Skype, not so much maybe, Hotmail, LinkedIn, Bing, GitHub, Surface, Xbox. It just keeps powering on, Pete. You know, and today it's up in the markets, and it's powering, you know, the US markets, because they're going, oh, maybe things aren't so bad. You know, it's absolutely just fantastic company, mate. And this is what I'm saying about buying big companies and big quality companies. Sometimes, you know, you can be assured that they're going to be around the next 5-10 years, unlike some of the tiny companies that we've got that everyone wants to buy, these little minuscule, you know, AIM stocks, you know, like 4D. You know what I mean? In a hope that they will get a lottery ticket, and then they don't.
We've all done it. Looking on SharePad, now I think you said that Microsoft was ahead of expectations, wasn't it? Beat expectations.
Yes.
Yeah. Right.
Yeah. Market expectations. Yeah.
Looking on SharePad now, the forecast showing on SharePad is forecast P of 31.2, and then 2-year forecast P of 27.3. You don't get much yield. But the really interesting thing about that is that is before the analysts have upgraded their expectations. So those numbers that I just mentioned, in reality, are actually more attractive than that. I think a PE of 27, whatever, on a stock of that quality is probably okay. I think, you know, it's not cheap. It's no bargain, but it's not massively expensive. It's not massively overvalued. For what you're getting, for the kind of growth, for the kind of dominance, for the kind of leadership and monopoly, it's actually pretty damn impressive. And the other thing, I was just looking on the chart, yeah, on Monday, it's one of the best examples of a hammer you will see. And it's absolutely perfect, because it goes, you've got a string of down days. Anyone can look on the chart, set it to candlesticks, daily candlesticks. You can just see a run for over a month of down days, down days, down days, down days, down days, down days. And then after all those down days, you've got one of the best hammers you've ever seen. That is such a great signal that this trend is going to turn up. Yesterday, it just did a little doji and didn't really do much. Today, it's gapped up and it's up today. Well, it's up 4.9% today.
The thing that staggers me about Microsoft, and it's a company which I've never held, and it saddens me to say it, you know, because it's a tech stock, and it's always one of them that I've always said, oh, it's probably too expensive, or probably its date's done. You know, these things, these fads of whatever they're involved in won't last. And I've been completely wrong. I've read this wrong so many times, Pete. And this is something I want to share with people now, because I know that so many of you ladies and gents out there have got a link to, or a association with, or an investment with, or whatever, with Scottish Mortgage Trust, right? The 10-year annualized total returns on Microsoft, right? 26.24, right?
What is that?
5-year annualized, 5-year annualized return is 36.17. The 3-year annualized is 40.1. The 1-year return on Microsoft is 26.9. Right now, I'm going to give you the ones for Scottish Mortgage. Now, bear with me here.
Mate, are those CAGR 1-year equivalent figures?
That's 1-year total returns, Pete.
Those are staggering.
1-year total percentage returns. Okay. Now I'm going to give you the returns for Scottish Mortgage, which is the tech stock. Now, Pete, you're buying in Microsoft. You've got exposure to a large behemoth company with lots of different aspects to it. You're buying into a trust. It's got lots of different entities within that trust, within the portfolio. So people buy a trust for reducing their risks. I understand that. The total returns for Scottish Mortgage Trust 10-year is 24.41, less than Microsoft. The 5-year 25.6, less than Microsoft. The 3-year 30.5. I'm gonna have to go back and have a look. I think that was less than Microsoft. The 1 year was definitely less than Microsoft. It's 20.4. It's lost in the last year. So let me just go back and just check that Microsoft 3-year bit, which I had on another screen here somewhere. The 3-year for Microsoft was 36.1. Again, better than Scottish Mortgage. So you can either pay the fund manager, or you could have chosen to buy Microsoft. I'm giving this out as just something to check sometimes when people are thinking of buying trusts. I believe that trust de-risks, your situation if you're buying a behemoth. I don't hold either, so who am I to say what you should do? I'm just saying sometimes consider sometimes which stock you're going to buy, and which fund you're going to buy, and which trust you're going to buy. And sometimes you don't have to pay the fund managers.
Yeah, it's a funny one, because I think because of the size of Microsoft, because of all the little bits of different tech it's in, it's sort of like a fund anyway. You're sort of onto something with what you've said. The only thing that I think you're not diversifying so much is that you sort of only got one board, one CEO, one CFO, whatever you want to call them. So you've sort of got less diversification in the management of the company. So if that board screws up, then you're in trouble. You know what I mean? But when you consider that Microsoft really is a load of businesses that are all joined up together, and they've all got their own management all the way through. So there is actually a lot of diversification of management within the actual organization itself. It's just that sort of high strategic level that you won't have the diversification you would get in a fund.
That's what I was going for, Pete.
That's really you've got me thinking, because that's an interesting one I hadn't really considered before. I hold Polar Capital Trust PCT, which has probably performed nothing like those two, so I'm now feeling a bit of a fool.
But Pete, we choose the ones we choose because sometimes it gives us lower risk, and when things are going okay, it does okay. When things are going really bad, it doesn't do as bad as the ones that everyone else is in. You've seen the sell-off in Scottish Mortgage Trust.
Oh yeah,
it will rebound. It will do well over the long term. But you've got to remember, it was this time last year that Bailey Gifford was selling off a big chunk of what it had in Tesla. Yeah, and that was what carried that. It was unassailable sort of returns that SMT was getting. It still got a bit of Tesla, but Tesla's rolled over a little bit, and a lot of the other holdings has rolled over a little bit.
Oh yeah.
So that's why it's been going off for the last month and a half, 2 months. But what people need to realize and understand as well is that have a look back at where you bought SMT. Have a look back what it's done in the last 18 months to 2 years. If you've held it for 2 years, you've done absolutely phenomenally well. The fact it's down 10, 15, 20% in the past month, 2 months, you should be at ease with that, because you're holding it for the next 2 years or the next 22 years. And this 10% or 20% move might be absolutely meaningless.
You've got to take the rough with the smooth. Mate, can we have a quick musical interlude that's got no music whatsoever? It's related. It's related, right? It's about tech, yeah? Right, I'm going to throw me notes away because it's nothing to do with that. All I was going to say, right, on Saturday night, went round a friend's house, yeah? And they got kids and whatever. They've got one of these, these Oculus, I'm doing it, right? These Oculus VR, virtual reality headset things, yeah? You ever use one? You ever use one?
Nope.
Mate.
Oh, sorry, I went to somewhere in Nottingham. I took my daughter out for the day, and they had one of those where we played games into virtual reality. Yeah, we went to do that. Yeah.
So you've had the thing where you put it on your face, so it goes in front of your eyes. Yeah. Well, I've never used it. I mean, obviously we've all been hearing about virtual reality and metaverses, and we did the great podcast with Kat, where we had an excellent guest in Katrina, and so I've been quite sort of like intrigued by it all for some time, and all all the stuff around blockchain and NFTs and that is all sort of related to this kind of weird stuff. Anyway, I actually got the chance to actually use it, and I had one of these headsets on my face, and I got to say, apart from the fact it was blocky, what I mean, because it's an Oculus one, I think they're about 399 quid or something, and I mean, I wear glasses, and I was able to keep my glasses on with the thing over my face, which was actually quite impressive that you could do that. It didn't make my eyes hurt, which was even more impressive, because I thought, oh my God, this is gonna, like be all in your face kind of thing. Like I say, it was a bit blocky, but the sort of game thing we were doing was like, it was completely daft, because it was like you were in an office. So you had like a PC in front of you, and you had a desk, you had a coffee machine, and you could use the sort of hand controllers to pick up a coffee, get yourself a cup of coffee, use the printer and all that. I mean, why on earth I would want to, I mean, it really reminded me of my Fujitsu days. Why I'd want to do that, I have no idea. To me, it wasn't a game at all, but the kids seemed to love it. But I must say, I was really impressed, and it is so immersive. So I literally was in there, and being a wheelchair user, I often, rather than pushing myself around with the wheels kind of thing, I sort of like grab hold of a sofa or something and just sort of push against it and move myself around. It's just something you naturally do. I was in this VR thing, thinking I'm at a desk, with a computer in front of me and whatever. I literally leant forward to push myself back off the desk, thinking that's the world I was in. But of course, the desk wasn't there, so I nearly bloody fell out my chair. I go flying forward. my friends are rushing up to try and save me, sort of thing, But it was that real that I actually thought I was in this weird fake world of a blocky, animated looking Toy Story kind of desk in front of me. But I have to say, I mean, the technology has obviously got to improve. It's obviously early days. It's obviously a cheap headset. But I was pretty damn impressed. And you can see these things becoming even more stunning in the years. And whether I'd want one's another story. I think I'd end up all battered and bruised if I did.
The interesting thing about you talking about Oculus headsets, Pete, is that if you go back in the day, right, this is how far back they were talking about VR, right? And if that company was to be bought today by anybody, it will probably be a £100 billion company, right? This company is owned by Meta Platforms. Meta Platforms is essentially Facebook.
It's Facebook, right? Yeah.
Facebook bought Oculus in March 2014 for 2.3 billion pounds in cash and stock.
Wow.
Right? That now is worth, I don't know how much, mate, a staggering amount. And this is what I'm saying about
they were mad.
We were looking at virtual reality then, now, and also now into the metaverse. So what Kat was saying about look at what's going on, look at future tech and all the rest of it, they've been looking at this for now on 6 to 8 years, right? You've got Microsoft just came out and just said it's going to buy Activision, yeah, because of the gaming side of it and because of the metaverse.
Absolutely,
they're going to invest $50 billion on Activision, mate. That tells you how serious this game is going to be about, Pete. There's more to come in this metaverse, and people will mock it, just like they mocked Bitcoin 5, 6, 7, 8 years ago. And now all the banks are getting into it. You know, it's rolled over the last couple of weeks and it's halved in value. So everyone's going, ha ha, I told you Bitcoin and all the rest of it was nonsense. But the banks are going to get into it. The governments are going to get into it, you know. So just watch this space for metaverse, mate, and virtual reality, because it ain't over yet. And there's more big companies going to be throwing money into the metaverse and investing in it heavily.
Oh yeah, yeah. It definitely is, mate. Hey, did we all talk about some stocks?
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a TwinPetes Investing podcast listener, you can access an exceptional offer via SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special TwinPetes offer is available to new subscribers only, and you can subscribe using the promo code TwinPetes. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe to SharePad today using the TwinPetes promo code, and you can save up to £69. Visit sharescope.co.uk/SharePad for further details and subscribe to the investing and trading analysis and data you need.
Go, you can lead, mate. Go ahead.
Oh, yeah, right. Okay, right. Oh, well, I better quickly just say I sold CLINIGEN, CLIN, after a takeover bid. The takeover bid was the offer amount was raised. I think it was the first offer was something like 88p or something, and they raised it to I don't know 97 or something. I honestly can't remember the numbers. Anyway, whatever it was, I sold my CLINIGEN because I don't think there's going to be another offer now, even though I do think it was bought on the cheap. But part of the reason I sold it and I moved it on and wasn't more patient was that I've been looking at a company for quite a while called Appreciate Group, APP. And I even mentioned it on a podcast probably about a year ago. It was a long time ago I mentioned it because I know it hasn't really done much. And I've been sort of watching it for ages and just keep seeing it go down, you know, which actually as a non-holder, I was sort of not too unhappy about. Anyway, APP had results the other day and I've actually now bought some. And I just think it looks really cheap. It used to be Park Group, you know, Park Hampers or whatever they were. Yeah,
yes, I remember it. Yeah.
And what got me really interested, and like I said, I talked about it a year ago. You can go back and find the podcast episode. But what got me interested in it was that they were, because what they do is they do these like Christmas hampers things where people, it's like a Christmas savings scheme where people can pay in like, you know, whenever they got a spare fiver, they pay a fiver in and whatever. And they pay it all year to save up for Christmas so they can have a really good Christmas. Because for a lot of people, they just don't have the money otherwise, you know. And it is actually surprisingly popular. I mean, you'd be amazed how many people do this. But the other thing is they also do high street vouchers and things, so you can get like gift vouchers through them and all that kind of stuff. And there's a website called highstreetvouchers.com which they do, but they also do these like company incentive schemes. So you know, a lot of companies, if it's like a sales organization or something, like say Double Glazing or something, they might have like a bonus thing where if you are the best selling salesman in that month, you get 100 quid's worth of capital bonds or something, which are like these special I mean, basically they're just like money, but you can only spend them in certain places. Anyway, what's really interesting is that kind of stuff's been around for years, right? And there are obviously paper vouchers and whatever. But what's happened now is that Appreciate Group has gone totally digital. Everything they do is digital. They're not handing out paper vouchers anymore. It's now done on an app on your phone. And you think how much this saves the company in terms of printing costs and all that kind of stuff and the distribution of it. I mean, imagine how much it costs to send these poxy vouchers out. I mean, the whole thing is absolutely nuts when you think about it. But the other thing that's really interesting about it is that it gives them marketing opportunities as well. And they're investing a lot in improving their social media marketing and their internet marketing. They started doing TV adverts for the park hampers. I don't remember the last time I saw that happen. You know, that's literally the first time. And they're quite a good advert because they're sort of saying, you know, I know you're all sick of Christmas. We've been ramming it down your throats for ages. Well, now we're going to do you another Christmas advert, but it's actually for next Christmas. It's quite a clever way they've done it. Anyway, the bit that really stood out to me, apart from all that, you know, that major change, was the fact it's got new management. And I always want to see new management in a company that's not been doing so well. It's been a bit soggy. I want to see new management, new ideas, getting things going. That's exactly what's happening with Appreciate Group. Now, I was saying, I think it looks really cheap. So here I am, right, talking my own book. I'm just looking on SharePad now. I probably do know the numbers from memory, but I just thought I'll beam it up and get the proper numbers for our listeners, our wonderful listeners. Right.
Can I just say something while you're pulling those numbers up, Pete?
Yeah, go on. Yeah.
I held it. I'm just pulling up my record. I thought, yeah, I remember that one. And it was Park Group. The ticker symbol was PKG at the time.
That's him. Yeah.
And I bought it and put my note out about this on the 9th of January, 2017. And I bought it at 81 pence per share, right? And I held it through thick and thin and up and down and all the rest of it. And I think, I can't even remember if they used to pay a little bit of a dividend, but
it did.
I'm trying to get right to the bottom.
Good dividend.
Good dividend. Yeah. So it went up, down and sideways, mate. What have I done here? Added more at 83 pence or 80 pence or something like that. Just got, and I eventually sold out about a year later. So it was December 2018, a year and a bit later.
Yeah.
Nearly two. Yeah. So I sold out at 68 pence or something like that.
So you lost
I took a bit of a, no, 73 pence I sold it at, Pete, and it closed at 68 pence. So I sold that for a little bit of a loss. I just got frustrated with the fact it wasn't going anywhere. Just to be trapped in a trading range. And they've been talking about going further and further and more digital for the past 4 years, really, 5 years. And the fact they've got to that now, as you said, as you've rightfully pointed out, the efficiencies that they will have because they're not printing this and printing that and doing this and doing that. It should really, really help them, mate. And the share price is currently at 25 pence instead of 70 pence over the past 3 years. So could be an opportunity there, mate. So well spotted.
Well, what was interesting was that obviously COVID has affected it as well. So part of the reason I think part of the reason that it struggled is because of COVID in the last 2 years or so. But I think the new management is on the ball. Anyway, looking at the looking on SharePad, it's on a forecast PE of 8.3. It's on a 2-year forecast PE of 6.3. It's got cash, so the true PE is effectively lower. Also, you've got a forecast dividend yield of 6.5%, rising 2 years out to 8.2%. It just looks really goddamn cheap. And if you think about it, if that was just to double to a forecast PE of 12, it would have to double in price. So there's 100% upside just to get to a forecast PE of 12, which would still leave upside. So I think this, my own target is 75p, and I think it could do it.
Wow, that'd be a three-bagger then for you, Pete.
Well, you know, it's like we said, there's no sureties in this game, you know, but you've got to get yourself into situations where the odds are actually in your favor. And I think this is one that looks quite promising. I've only bought 1.5% of my portfolio so far, partly because I ain't got any spare money. And we'll see how it goes, but I mean, it's certainly one I would like to buy more of if I get the cash, if there's nothing else I want to buy. And if it starts showing some proper upward momentum, but I'm quite happy to sit in with what I've got, picking up a lovely dividend. Let's see what happens.
Okie dokie. The stock I'd like to share with people today is one I've had my eye on, and I thought it was coming back down towards where I could get a reasonable sort of chunk of it at a good price. But I've probably been a bit too greedy or cheap, or whichever phrase you want to use on it.
You're big cheap,
yeah, because I wanted it a bit cheaper, and once again it's just pinged away from me. And that stock is OAKLEY Capital Investments. It's a private equity and venture capital firm. So it invests in a lot of, well, I don't want to say liquid, but unlisted stocks. And today it came out with its, sorry, I've got something on my chest here, trading update. And it's just absolutely motored. The trading update was really, really positive. Wow. It ended up 9%, Pete. It'd gone below £4. I was like, come on, get down to £3.50. And now it's at £4.19. Essentially, what they came out with today is they said that net asset value increased 21% in the second half, whilst the full year return was 35%. And during the year, 76% of the increase in the portfolio's value was driven by EBITDA growth, and 24% by multiple expansion, including dividends. So that means that what they were buying on a private equity basis and a venture capital basis, they were able to sell for far more than they bought it for. And the value of some of the companies that they're invested in increased as well. So that to me just shows good management of the company, of what they're doing. One of the key contributors to OAKLEY's net asset value growth in the first half was a disposal of information services platform Tech Insights at 125% premium to what they valued at in June, Pete. So, that just shows that the scale and the speed of what some of these tech stocks within their portfolio had done, and just absolutely blew it out of the water. Bizarre thing is, it was rolling over because it's a tech-related entity, year to date, and it's still currently trading at a bit of a discount to the December 2021 net asset value. Is it risky? Probably. So it's one to keep an eye on. I like to look at things that are tech-related, as everyone knows by now. So it's one that I've been wanting for it to come down, and it didn't quite come down to where I wanted it to. One of the stocks that I did have in my watch list that I've been waiting for. As I said earlier, I stepped in and bought my first tranche of it on Monday, and I'll be keeping an eye on that at some point or other, and try and add to that a bit more going forward. And everyone knows I'm not in the business of sharing my 100 hours of research on this podcast before I want to. So I'll share that as and when I'm ready.
That's OCI, isn't it? OAKLEY Capital Investment.
OCI, yeah, it's ticket symbol for that one. Yeah,
that is one that actually does seem very well managed, and it's one that Simon Thompson's written about for years, and he's been absolutely hang on with it. And you look at the chart, 3-year chart is just straight up. It's an absolute gem.
It is,
mate. One that I've had on my list. I'm going to show my list. There's my list. Right. My infamous list on what we're going to talk about on the podcast. And I've had this company on this list now for about the last 4 podcasts. I've never mentioned it. Don't know why. Probably because others have been on my list as well, and they've taken my fancy. But today I'm going to mention the poor old devil. Do you know what? I might change. Do you know what? I'm now thinking of changing my mind and mention another one. No. I'm going to mention SAG, which is Science Group. Yeah. I just think it's a really interesting business. I don't hold it. I don't have it. I've never held
I'm sure
it.
you've mentioned that before, though, Pete. I'm sure you've mentioned it before, mate. That one.
No, definitely. I might have mentioned it to you off of the call or something. I don't know.
Oh, okay.
But anyway, Science Group, yeah. I'm not even really sure what it does. I think it's a bit like Judges Scientific, where they own loads of like little sort of specialist sort of tech science laboratory kind of sort of companies. You know, I think it's that kind of thing. Very much like Judges Scientific, JDG. I think it's very much like that. But what struck me about it when I was reading, I mean, I remember Richard Bedard, yeah, the legendary Richard Bedard, good guy. I remember him writing up Science Group about 2-3 years ago, and it just sticks in my brain that he was going on about it, and that got me interested. And anyway, I read their update, you know, 3 or 4 weeks ago, whenever it was. And what struck me about it was they were very much about growing the company and doing more acquisitions, which is, again, is the same sort of model that Judges Scientific has done, the same sort of thing that Scientific Digital Imaging have done, but they've all been buying these little companies and adding them on, you know. And they've got like extra funding facility and they're looking to grow and all that stuff. Now, looking on SharePad, SAG, it's on a forecast PE of 15 and then a 2-year forecast PE of 15.7, which is a bit weird because the PE should be going down. So people need to look into that and understand what's going on there. That it actually wouldn't surprise me if the forecast is complete and utter nonsense. And it's got like a 1.2% yield, so not much. But they got cash, I think. And, you know, if that one keeps expanding and stuff, if it keeps doing little bolt-on acquisitions, and if it can do them well, a lot of ifs, I reckon that could be quite an interesting little play.
Okay.
Chart. I mean,
it's one that I can't say I've ever really looked at, Pete. I've seen its name bandied about all over the place. You know what I mean? It used to be because I always used to get it mixed up with Sangentia.
Yes. Yeah, I know what you mean.
Yeah,
that's weird.
So, yeah, it's an interesting one, but it's one I can't really comment on. I've not looked at it enough and read enough about it.
Yeah.
So it's an interesting one. Pete, I'm gonna close this with one more stock. I've already mentioned Microsoft and the other one.
Okay.
I'm going to mention this one. It's one again that I keep waiting to fall into my buy zone. And every time it gets almost near it, it moves on. It's been on my watch list for about 3 or 4 years. This stock, it's so frustrating. It's one that we've all probably been impacted by, and we don't even know it. And it's the credit checker. That's what I call it anyway. EXPERIAN.
Oh, EXPN.
Yep. It's a global information services company that helps businesses manage their credit risk, prevent fraud, and targets marketing officers and automated decision making. Yeah, the group also helps people check their credit reports, credit scores, and protects against identity theft. The company has credit data on 1.3 billion people and 166 million businesses. The ownership of such rich data, this is about big digital big data we're talking about again, folks, right? This is the gold of the future, data. And these companies like Amazon know more about you and the businesses that we're working in than the owners do. Yeah, and they came out a couple of weeks back. If I get my Pete, I'm really struggling with my throat today. I'm not sure why.
Got a frog in it, mate.
Yeah. So a couple of weeks back, they came out with their data, released a positive update and trading for the 3 months to December 2021, third quarter of the year for March 2020, and they nudged their guidance up for the full year just a little bit, Pete. And I'm thinking, with all this inflation risk stuff, people getting jobs, losing jobs, you know, people having to check whether they can apply for a new mortgage because mortgage rates may or may not go up in and around the world, especially in America if interest rates go up. I'm thinking, you know what, will there be opportunities here for them to grow a bit more and also increase their growth in emerging markets? So that's one I really would have liked to have bought, you know, 3 or 4 or 5 years ago, but again, I was too cheap and I wanted it a bit cheaper, and share prices just carried on and carried on and carried on. The 52-week high on the shares was at £36.89. The 52-week low is £22.65, and it was just almost inching towards £29 on Monday. Today it's at £29.76, so it's had a bit of a rollover in that sense. But if I tell you, I'm going to pull up the 5-year charts now. This is how embarrassing this is. 5-year chart, if I go all the way back to Feb, I've got a date here, 4th of February 2017, the share price was £15.65, and it's been as high as I've just said, £36, nearly £37 for a behemoth, or not a behemoth in American scale, but for behemoth for the UK size. It's a £26 billion company now, and last year it did about 14% for the whole year. Year to date, it's down 18%. So I've got my eye on that one. I haven't purchased it. I haven't bought it. I'm being a bit cheap, so ideally I would like to buy it at sub 28 quid if and when that happens. And if it carries on rolling down when it hits 28 quid, I probably want to buy it at £25. You know what I mean? That's just the way that I am. But it's one I just think with big data and the way things are going, and people changing jobs, you know, remortgaging, buying cars. We've talked about everyone's buying a car, Pete. All those credit checks that need to be done for people buying cars, and not everyone's buying cash, Pete. And people leasing cars as well now. Or want a new Tesla, or I'll lease that. You know what I mean? So they've got to do all the credit checks and those sort of things, Pete.
They all need credit checks. I mean, it's
all
funny
credit
enough.
Checks, mate.
Funny enough, Investors Chronicle had this as one of their main tips a few weeks ago, and
don't say that.
No, it's good. It was a really good article, and what really stuck in my brain about it, apart from the fact that I used to bloody own them about 10 years ago, and I don't even want to. I don't want to even think about what they'd be worth today.
Sorry, mate. Sorry about that.
No, I say it all the time, don't I? My biggest mistake is selling stuff, and so that's why I don't sell anything anymore. Because I just end up
extreme to the next, mate. Come on.
Hey, I just end up beating myself up all the time because I have to spend my life looking at stocks that I sold for a fraction of what they are today, and it absolutely kills me. Yeah, so EXPN, the thing that stood out is the IP, the intellectual property, the value in all of that data they've built up on you and me and everybody else listening to this podcast and everyone else in the world. They have got databases and access and the ability to read those databases and extract that information that they've been building over years and years and years and years. That's got serious value. That's serious IP. Looking on SharePad, it's on a forecast PE of 32.7. This is just under 30 quid, right? Forecast PE 32.7, 2-year forecast PE 28.7. You're getting 1.3% dividend, and that's going to increase to 1.5 hopefully. Little tiny bit of borrowing. I don't think, I mean, it's not cheap. You know, let's not fool ourselves.
Cheap, no. That's the reason I want to buy it cheaper, Pete.
Yeah, well, you know, it's not a cheap stock, but I reckon people who were to buy that today with a 5-year view would probably look back and think, actually, that wasn't a bad decision I made. I did all right on it. And I'll tell you what, I reckon there's a real chance a company like that gets taken over by a big American player or whatever.
Oh, I hope not. I hope not. I say this all the time. I get a lot of takeovers to buy things like recovery stock or deep value, whatever. I don't want most of my stocks to be taken over, Pete, because you have to find a replacement. And what do we have that can replace Experian? We haven't. That's only one company of its kind of that size that we've got.
Nothing. Yeah, you're right.
Lost it. Yeah. Once we've lost it, what do we have as a UK behemoth that does that? We haven't got one.
No, exactly, and it would be gone. The other interesting thing, if you look at a chart on it, it's fallen away over the last, what we're talking about. We're talking about 1 month, right? 1 month is just dropped and dropped and dropped and dropped and dropped and dropped and dropped. But if you look at the candlesticks on it, it's dropped and dropped and dropped. Now it is just leveling off, and it's interesting. It hasn't tried to push up yet. I would say really, if it's going to start moving up again now, it needs to get over that £31 level. If it gets over £31 and closes above £31 with a decent up candle or whatever, that would be telling us that that drop of the last month is now changing and it's starting to move up again. But yeah, it's interesting that it hasn't partaken in the rally today much.
Yeah, it's down 18%-ish year to date. It's gone up 1.7% today. I didn't want it to go up at all, but you know, other people do hold that stock, so I'm pleased for them.
The other interesting thing with a chart pattern like that, when it's gone down, 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 and down, and then it just goes sideways, that often means it's going to fall again. It's just it's like a down move, a sideways consolidation, then it falls again. It's called a bearish ledge. So you might actually get what you want. And do you know what? With the way the market mood has changed towards high valuations, we talked about this on the podcast before about discount rates, higher inflation rate, higher interest rates, and all that kind of stuff. You know, the market is not as tolerant of these high valuations anymore. So something like Experian on a forward PE of 30 dropping to 27, the market might say, well, I'd rather be paying 24 for that. And so it wouldn't surprise me if we do see these kind of things come off a bit more. Not to say it's not a brilliant company.
It's a brilliant company, Pete. But once again, it's one of those things whereby we have to be mindful. We've had the volatility of Monday. Where we're all just went, ah! And Tuesday we've got a bit of a rally or a calming, and then today we've had the markets pop higher. But we don't know if it's over yet. No. We need to be very, very careful with regards to it all. I suppose I want to close a little bit of psychology here and give you two Seth Klarman quotes, and it's to do with psychology. And his most famous one is probably this one, and I use it quite often. Investing is the intersection of economics and psychology. Yeah, and I spoke with a fund manager only probably last week now, and we were talking about this thing to do with psychology and how important it is, and it's a huge weighting in how well we do. And I spoke with a former editor of a magazine, I won't name who that is, just yesterday, and what was his words to me? He says, Pete, the biggest risk to any investor is the investor. Yeah? Absolutely. We are our own worst enemies, were his words.
Absolutely. Pete. Yeah.
Absolutely. The second Seth Klarman quote is, value investing is actually a comprehensive investment philosophy that emphasizes the need to perform in-depth fundamental analysis, pursue long-term investment results, limit risk, and resist crowd psychology. Think for yourself, think independently, do your own research, don't copy other people's ideas, and also think about when you're going to sell. Sell when you want to sell. Don't wait for the herd to sell to force you to sell.
Yeah, all makes sense, mate. All good stuff.
Okay, Pete, anything you want to add?
No, I think that covers. I think we've covered a bit of ground in this podcast as hopefully, I was going to say as we usually do. Hopefully we normally do that. But no, I think there's a few things in here and a few ideas, and hopefully listeners will have enjoyed it.
Cool. Just one last thing for me to say here. We've obviously closed the TwinPetes challenge for the Menphys one, and we're going to do Pete's as soon as possible when that goes live. We had one sneaky person jumped on and donated a little bit more money. So we've had Naquib, so I'm just giving Naquib a shout out, and he wrote, the thoughts counts, but the pounds counts too. A small gesture for a good cause. Thank you, TwinPetes, for highlighting this cause. So he made another donation, so that's topped us up a little bit further.
Thanks, Naquib.
So that might be the last one that goes in there. But I just wanted to say again to everyone that's made a donation to the charity, and the ones that are looking forward to donating to Pete's backup charity when we launch it. It's all appreciated, folks. And as Pete says, if you look up and take care of the investing gods, by making donations, your portfolio will probably do well as well.
So it's so true. It's so
Is
true.
it true? Yeah, cool.
You've got to respect the market gods and give them some sacrifices every now and again.
Absolutely.
That's what
absolutely.
it's all about.
So
silly point. If people wanted to still give something to Menphys, it's still up, isn't it?
It's still up. The page
they
is,
could still
the page
do
is
it
there.
if they want.
What I'm trying to do is I'm trying to hold them back, Pete, so they all wade into to yours once you launched it. So.
They can wade into mine as well. But if they've heard about the Menphys charity and they do want to give some money, go ahead, give them money. I mean, no one's going to mind. No one's going to complain if you give money to them.
No, they're certainly not going to complain. That's cool. Right. I'm conscious that we've been rambling on again, and we've done over an hour again. I'm going to try and get Pete and me to get this down to less than an hour. I know some people are saying after the last one, oh, an hour and a half, please make it longer. I'm going, absolutely not. Absolutely not. I'm struggling here with bad throat and dry throat. Yeah, it's like I went for a 7-mile walk. I'm like, oh my gosh.
I was going to say the battery on my laptop wouldn't last long enough. I'm thinking my own personal battery wouldn't last long enough.
Absolutely. So, folks,
I'm not sure my pacemaker would last that long.
Oh dear. Folks, ladies, gents, wherever you are in the world, thank you ever so much again for your fantastic feedback for TPI, TwinPetes 66. The feedback's been absolutely phenomenal. Again, we had some fantastic numbers for that one again. So thank you ever so much. If you've enjoyed this podcast, any element of it, please share it with other people. Please retweet it and share it and give your comments. If you haven't, please, again, share it with us what you didn't like, what we said that you thought was a little bit off piste. And it enables us to improve. So keep sharing it, keep giving us your feedback, and we'll keep trying to improve it. The secret sauce of last week, or the last podcast, and this one, if you've noticed the difference, and the reason why I was trying to stop Pete saying anything in the last podcast, he was desperate to tell you all, is that Pete and I have arrived in the 21st century. We've actually recording this on Zoom. We can actually, for the second time, other than where we've done events, physically see each other. It hasn't stopped Pete interrupting me. It hasn't stopped me interrupting Pete, but we can actually see each other, and we hope that this will improve some of the commentary we do with you guys going forward, and we might even scare the wits out of you at some point by showing you, ladies and gents, our two ugly mugs on video. We'll see how that goes going forward. We might even use this one. We don't know.
You never know. Promises. You might actually be watching. All right, ladies. When you hear that, who knows?
All right, ladies, gents, that's a wrap for TwinPetes 67. We will see you in 2 weeks. We hope the market behaves for you. We hope your portfolio does well. We hope whichever stocks that you're holding your head out and going in shame, I wish I'd bought that, like my 4D stock, rallies for you going forward, and that you have some good news. But the most important thing of all is just to stay healthy. Stay healthy, look after yourselves, and do what you can for others. Take care. God bless you all.
Bye. See ya. Thank you, everyone.
This TwinPetes Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.